Let's start with the payment stocks, if you don't mind.
Sure.
MasterCard trading near an all-time high. What's your take? Would you still buy into the payment stocks? We're talking MasterCard, Visa, also Discover.
Morning, Frank. Yeah, I think that if we consider where the financials are right now, right? JP Morgan obviously was a surprise with their earnings report, and some banks have still yet to report here, but we don't necessarily expect it to be great. Of all of the financials, I would prefer to own Visa and MasterCard right here, even though they're not thought of as financials in the more traditional sense. They're more fintech, really. But these two companies sit perfectly wedged between every single transaction that you or I makes with our credit and debit cards, and all of the trillions of dollars of payment flow that happens around the globe each year. They earn a little piece of that each time, and it doesn't cost them anything more for each additional swipe that you or I make. So once they build out a network, every additional swipe that we make is just more profit for each of these payments processors. So I think that is a great place to be, and dare I say, maybe even a recession-proof business model.
You know, that's an interesting point you bring up, Malcolm. It's something I want to talk to you about. We're seeing credit card balances hitting $1 trillion. We're seeing the interest rate on credit cards hitting 22%, also a record. And then also student loan payments restarting up in the fall. Are you worried that would impact the business of a MasterCard and a Visa?
Well, it may slightly decrease the amount of each transaction because obviously their take is based on a percentage of the swipe. But I would say that anyone who's bet against Americans' willingness to spend over the last 2 or 3 years has definitely been outside of the trade looking in. And so I wouldn't necessarily suddenly have a change of heart here and expect that suddenly Americans are going to have less willingness to spend. Do they have the capacity to spend? Are there as many dollars available? That begs to be seen.
All right, noted. We're going to get through a few more things, so let's go a bit faster here, Malcolm, if you don't mind.
Sure.
Several home builders also hitting fresh highs. We're talking about D.R. Horton, Lennar, and Pulte Group. This is mortgage rates hover near 20-year highs. Bit of a theme here. What's your take on these stocks?
Yes, I wouldn't necessarily want to own the home builders here simply because, like you just pointed out, the interest rate environment and the fact that there's still such strong calls for a recession among economists scare me a little bit as far as home builders are concerned. But if I had to choose one, I would go with D.R. Horton simply because of their ability to build in all markets, right? So whether it's entry-level, custom, or luxury, if one price point is negatively impacted more than others going forward, DHI has the ability to make up the difference among its other business units.
Let's get you back over to tech. We got some other winners. Adobe's trading at levels not seen since February of last year. Booking Holdings is trading at all-time highs back to its IPO back in 1999. And Sherwin-Williams, just a consumer-facing name, trading at levels not seen since last June. Do any of these names excite you?
Yeah, of all the names you just listed, Adobe is the one that I really would love to own here. Because instead of running from AI, they've embraced it, right? And they happen to debut Firefly AI at the perfect right time because more and more artists and creatives are becoming accepting of AI. And the Firefly AI offering that they just rolled out allows them to offer their own treasure trove of unique works to these creatives. As more artists and creatives are becoming protective over their work, right? They're out there suing for ownership rights of the AI that some of these large language models are trained on. I think that Adobe's treasure trove of original work is going to become more and more valuable, and that's what's going to drive this price higher going forward.
All right, Malcolm, stick with us just for a second. We want to get to China, another batch of bad economic data. This time around, second quarter GDP coming in short of estimates. CNBC's Sam Battis has that report.
China's economy grew 6.3% in the second quarter, missing expectations in the market of around 7%. Headline growth was better than the first quarter, but was heavily skewed by last year's lockdowns, which weighed on productivity and consumption in major cities like Shanghai. On a quarterly basis, the economy only grew 0.8%. The base effects also distorting the economic activity indicators in June, given the release of pent-up demand during the same time last year. Retail sales missed expectations at 3.1%, but on a quarterly basis only grew a smidge, which is further confirmation consumption remains weak as confidence remains low amid worries about jobs and income. Now, that was highlighted by another record high in youth unemployment. New home prices also logged the weakest showing all year, reinforcing the need for more stimulus for the property sector and to spur consumption. There were some bright spots, though. Industrial output surprised to the upside despite exports falling the most in more than 3 years and business confidence at factories at an 8-month low.
All right, we want to thank Sam for that and bring our Malcolm Ethridge back in. Another bad economic data read for China, Malcolm. This after the Crane Shares Internet ETF. It saw its best weekly performance since early March just last week and notched its 6th positive week in the last 7th. Given all that, are you investing in China right now?
Yeah, I wouldn't necessarily be investing in China right now, specifically because if those are the numbers that we're allowed to know about, I wonder just what they actually are. But the thing that I would point out more than anything is the youth unemployment number baked into those details, which doesn't necessarily bode well for U.S.-based companies that also depend on Chinese labor to do their business. And so I would be paying attention also to like a Starbucks, for example, which we know is very dependent on China, maybe a Nike, for example. Names like that also stick out to me as I hear that.